Banks and alternative lenders are lending again, so small business owners should easily be able to secure a loan. Yet many are still getting turned down, even those with solid credit scores. The reason? They aren't paying attention to the 5 C's of credit. I'm Donna Fuscaldo. I'm a senior finance writer with business.com. Today, we're speaking with Michael Caron. He's a senior manager at CBIZ Debt Capital, a consulting firm, and he's here to discuss what these 5 C's of credit are and how you can enhance them so you can secure a small business loan. Hey, Michael, thanks so much for taking out the time today.
Oh, it's a pleasure. Thank you for having me.
So we're here today to chat about the 5 C's of credit. But before we even get there, paint a picture. What's going on in the small business lending landscape? Is it easy or it's difficult still for small business owners to get funding?
I think it really depends on what the small business owner is looking for and how small or large they really are. You know, I mean, small is way smaller than it used to be. You know, I mean, you know, a company looking for $100,000 may seem like a lot of money to us, but to the banks, it's not worth even talking about. So, you know, what's happened is the really small companies that are looking for capital have had to resort to, you know, MCA, merchant cash advance lenders, or some other, you know, the avenue that is more conducive to that size. And that's, you know, unfortunately, that's not a very good way to go.
So if you go those routes, you're ending up spending a lot in interest on these loans. So they get expensive. So these 5 C's, what are they and why are they so important?
Well, I think, you know, without going through each one, I think the idea, and I tell this with people who I talk to about borrowing money, the issue is really who's taking the risk. You know, I mean, are you looking for the lender to take the risk? If that's the case, then it's probably not going to work. If you have the personal assets, if you're a really small company and you're willing to put what you have up, and provided you have something, that matters too. I mean, talk to people and say, oh, I'll be happy to guarantee, and they have nothing. Like, okay, well, that doesn't mean anything. So, you know.
So let's talk about these 5 C's. What are they? What are all 5 of them?
So the 5 C's are capital, character, collateral, conditions, and capacity.
What does character mean?
Character would be, you know, to oversimplify character, you know, any lender is going to run a credit report. And if your credit is good, then you're fine from a character standpoint. If lenders, especially non-bank lenders, will also run a criminal check. You know, they want to make sure you're not a felon. A felony check. So again, you know, these are some very basic things that lenders are going to look at to determine that, okay, you're not a criminal. You know, so obviously if you're dealing with a bank, you've gone through certain like the Money Laundering Act and certain things like that to qualify to even open an account. But I think once you borrow money, then it's like, well, who is this person? So, you know, and lenders will make sure that they're not making a mistake. I think that's the key. They make sure. And then so character would be, you know, that would be important to a lender. I mean, if you know that you've got a checkered background, you know, I mean, depending on how long ago it was, it may or may not be an issue. But the worst thing I would advise any lender or any borrower would be to try to hide it. You know,
excellent.
They will find out. The lenders will find out if you try to hide something. So
what about the second C, which I would assume is like the biggest one, collateral? What does that mean?
Well, collateral is important. I mean, collateral basically is, if something goes wrong, how do we get paid back? Which is what the bank is going to, the lender is going to be looking at no matter what. And, I mean, if you think about it, the borrower is going to would ask the same questions if they were going to make a loan to someone. What if you don't pay me back? What do I do? I mean, fine. So you got collateral. Now, banks and lenders, they really don't care about the borrower's collateral or personal assets. They just want their money back. And the collateral is a way for them to encourage the borrower to help them get their money back. In some cases, there's nothing they can do except liquidate the company. And then if they have receivables or equipment or whatever, real estate, they will foreclose. It takes forever, but that's the collateral. You want to buy a building, you put the building up. So again,
for small business borrowers, is it the more collateral you have, the better chances you are of getting a loan?
I think it matters. I mean, if you take a really simple example, if you've got a business owner who basically says, I want to borrow $100,000 and I'm going to put up $100,000 in cash. Yeah, sure, you can borrow the money. If you've got a business owner that says, I want to borrow $100,000, I've got nothing. That's obviously much harder. So somewhere in the middle, I want to borrow money to start a business, and I'll put my house up, and I have, my house is worth $1 million, and I got a $500,000 loan on it. Fine, you can have $100,000. If you don't pay me back, I'll sell your house. So, I mean, yes, it helps. But on the other hand, a lender is not going to be. Lenders don't just look at collateral. They're going to look at your experience. They're going to look at your projections. They're going to look at what you've done in the past. They're going to look at a lot of things to determine that it makes sense, because the one thing a lender doesn't want to do, they don't want to get involved in a situation that's not going to work out.
Now, what about conditions? That's the third, and I'm assuming that's out of small business owners' hands, or is that their personal conditions?
No, that is more of the economic conditions. It's really not anything the business owner can control or anything like that. The conditions of, for example, who knew we were going to be in a pandemic? That's condition. It's like, okay, well, if you're a restaurant owner and the economy shuts down, that's going to impact your business. You can talk all day long about how you're going to survive and all that, but the conditions are not in your favor. So I would say that it's not the owner's condition would be more in the collateral or the character. But again, the lender is going to look at, what are you trying to do? What are you trying to buy a business? Are you trying to grow a business? Are you looking to bail out a business? What's the point of the loan? And that's another thing. That's not actually talked about in the 5 C's of credit, but that's like one of the most important things when someone wants to borrow money. What are you looking to do with the money?
So in terms of the 4 and 5, we have capital and capacity. What does that mean to a small business owner?
Well, capital would be, what are you putting into the company? So a business owner who's making a personal investment into a company, he's capitalizing it with assets, with money, real money. That's capital. I mean, the way most businesses start, you have the person with the idea of what's going to happen, and then that person will go to family and friends and get them, because they trust them, and they will say, okay, we'll give you money. And so that's like round one. So you've got the small business owner will look to raise capital to put into the business to get it started. And the people that are the family and friends, which is generally the way everything starts in the small business world, they will agree that they will put money in. They either want a certain return, which is going to be higher than what they could get normally, or they want a piece of the action. In many cases, they want both. They want to own some of the company. They want, as they say, they want upside. You know, they want to know that if this works out, we get a very good return. And if it doesn't work out, they are prepared to lose the money, you know, which makes them an investor. So your first round of investors would be family and friends. And then the next round would be, okay, so now maybe you want to do crowdsourcing, or you want to do some other, you want to raise more capital. But
why do lenders care about the capital you've raised in the past? Is it to mitigate the risk?
It's based on your balance sheet. You know, do you have a net worth? Are you losing money? I mean, all those things. I mean, it's like you or me. I mean, if we're broke, who's going to lend you money? You know, it's the old story. I mean, if you've got plenty of money, it's no big deal getting a loan. You know, I mean, I think it's the same thing with this. If you've shown that you've done it, if you can demonstrate, it's all about demonstrating. If you can demonstrate that you're a good risk, you can get a loan, whether it's 50,000 or 50 million.
Now, what about capacity? What is that? Is that how much debt you have outstanding?
I think it's more about what can you afford, what can you absorb. So that's where what they call leverage comes in. You know, I mean, a company that's highly leveraged, again, if you just look at people like us, I mean, if you have $1 million house with a $900,000 mortgage and you're unemployed, you're highly leveraged. You know, I mean, your ability to service that loan is very shaky. You know, now if you've got a $500,000 house with no mortgage and no expenses and no job, it's like, well, okay, at least nobody take your house away. And if you want to borrow the money on your house, you can. So I think, again, you know, I don't want to oversimplify it, but you know, it to some extent, it's common sense. I mean, you know, when I talk to a borrower, you know, it's like, who's taking the risk? I mean, do you want me to take the risk? Do you want the lender to take the risk? Who's taking the risk? And when they say, well, we'll guarantee the loan. Yeah, what do you have? Well, we don't have anything. Well, it means nothing. You know, so I think all those things matter a lot.
So you, as a lending consultant, pro tips, what are some inside secrets or tips you have for small business owners as if they've gotten rejected and they need a small business loan?
The biggest thing that I see is that there are a lot of the people who are the lenders on the street can't make a decision. You know, the people that are running around, their business development, their salespeople, they're not deciding. You know, they like every deal they see, everything they see they like. And that can be very confusing to a borrower because they end up wasting a ton of time because they don't know that their loan has got no chance of happening because they've already been told by the person who can't make a decision that we like this project. This really makes a lot of sense. Like, it does. So I think that that's something that you know, in my role as a consultant, I see all the time where business owners think, okay, well, you know, we have these proposals. You do? They're just proposals. Do you have a commitment? No, we have no commitments. So, you know, I mean, it means something to have a commitment. So I think that that's one of the big things that I find can be very, very frustrating for a business owner, that they really don't know what's going on.
How do they learn? How do they, you know, empower themselves by knowing?
You know, most business owners don't do their own accounting. They hire somebody who they think knows what they're doing. It's just normal. You hire an accountant. I mean, I do my own taxes, but it's very simple. I get a W-2. press a few buttons on the computer, it's done. You know, so, but when you're talking about a business and you got expenses and all that, you need a pro. And I think that, you know, the same thing is with anything else. You know, I mean, if you want to try to do it yourself, you probably can. You can spend a lot of time researching and all that, but you're not really running your business then. So I think it's like anything else. When you need insurance, you don't necessarily go to the insurance company. You go to a broker who represents the insurance company and knows exactly what the rules are and how to deal with it. You know, so it's the same with this. I mean, and that's the hard part because, I mean, I don't work for free. I mean, I charge, and businesses routinely will say no, thank you, because they don't want to pay a fee. Like, well, and 99% of the time, the reason they don't want to pay a fee is because their deal really doesn't make any sense, and they know it. That's the other thing that I've learned over the years, is that the business owners, they know exactly the situation they're in. You know, they know their financial statements are not good. They know their history is bad. They know they're not a good character. They know all this stuff. You don't surprise them with anything. It's when they surprise, it's when you are surprised by what they didn't tell you. And that's, you know, something that I make sure that I avoid. So yeah, it's like, you know, as I tell people that deal with me, is that you have to treat me like I'm the lender. I mean, I get all the information. I'll make the phone call. I'll represent you. You make all the decisions, but you know, you run your business, and I'll do this. I'll consult with you. I'll help negotiate with you. I can read the documentation and see if it makes sense, because I spent way too much time in banking, you know, so I know this stuff. So that's the benefit.
Great. So there you have it. If you want to get a small business loan these days, focus on those 5 C's. Michael, I want to thank you so much for taking out the time today.
Donna, thank you. It was a pleasure.